Hello, Ben here with another episode of Flash. I'm recording this on Monday, August 11th. So let's just get to it, shall we? I would say that the best trade ideas are the ones where you have as much tailwind as possible. Okay, so that means the macro, the fundamentals, obviously, the price action, the option structure, and the sensible catalysts, everything kind of lined up in your direction gives you the highest chance of success. Obviously, it doesn't guarantee that you're going to be, have a winning trade on your hand, but it does tilt the odds in your favor. So I prefer to look at this from a kind of tops-down type of view, but it does imply that you know what to look for. Right? So ask yourself this: what has changed recently? Where's the wind blowing? Any surprising developments happening? What is going on? Because in order for a stock to have a solid move, there should be some type of catalyst, if you will, that kind of kicks it out of balance. That's when you get moves. It's not enough just to find a good company to be long or a bad company to be short. Right. So I would say at this point, the whole tariff narrative has just been beaten to death. Okay, so I'm not going to go there. But look, we monitor a ton of macro data here at ITPM, and I would say one of the most valuable data points we get is from the Institute for Supply Management. The ISM comes out beginning of each month, and there's a lot of valuable data in there. And in this case, I am zooming in on the sector breakdowns. So there are 18 major sectors ranked across various growth metrics, and the petroleum and coal product space have been at the top of the pack all year. Okay, so until the most recent report showing the data for July, where the energy space just fell way down in the pecking order, and it's now in neutral territory, and you might think like, well, okay, that's not too bad, it's neutral. Yes, but look, when you have the situation where all of a sudden, after like about 7 months, there's a big switch like that. Well, the wind is shifted. Something is going on. Something is brewing. Okay, and that can trigger trade ideas in our favor. So, and also, I mean, there's other stuff going on here. But for example, the CEO of Halliburton, he recently said that the oilfield service market will be softer than previously expected. And he continued saying that they expect the international revenue to contract, primarily driven by this reduction in Middle East and in Mexico and other places. So, and sure, like Halliburton could be a good short in itself, but I'm leaning more towards another major player in this field. Okay, Schlumberger, SLB. They have a bigger market cap, wider industry range, and just more global exposure. SLB also has a weaker balance sheet where the quick ratio is below 1, meaning their liquid assets are less than their short-term debts. And like a lot of big stocks in this field, they pay a decent dividend. But the problem is that Schlumberger's payout ratio is much higher than the other major companies here, where the payout ratio is like 38% last time I looked. And then you might say, well, that's great, right? Well, the problem is that if their earnings per share keeps weakening, they will be susceptible to having to cut their dividend payout, which clearly would be bad for the stock. And the stock has already been in an overall downtrend for like 2 years now. And it never even managed to rebound when we had the massive rally that followed the April sell-off, right, in the overall market. And fundamentally, they have negative revenue growth for this fiscal year and a pretty dismal earnings growth, clocking in at negative 15% for this year. And we're also seeing consistent EPS downgrades on a quarterly and annual basis, just across the board. So not really a pretty picture. All right, then. So with a bearish view of this stock, all right, plus the fact that September, October tend to be difficult months in the market, if you would say, I am setting this up as a calendar put spread. Okay, presuming a $100,000 portfolio where I allocate 5% to this trade, which would also be the max risk, considering that they have earnings out mid-October. So I can buy 30 of the November 32.5 strike puts for $2. That's going to cost $6,000. And then I want to make this a calendar spread, meaning I also want to sell puts to offset time decay and be able to capture some credits. Right, so if I sell the September 30 strike puts for 50 cents each, we can capture $1,000 credit if we sell 20 contracts. And I'm saying 20 contracts because that would leave me net long 10 puts, right? So long 30 November puts, short 20 September puts. Like that, if the market unravels in September, I'm net long puts. But with $1,000 credit applied towards a $6,000 debit, this is a $5,000 net spend, which is also the max risk in case the stock doesn't fall, go anywhere. With the stock at near-term support at 30, and I'm presuming it's going to hover above that level until September, I'll bank total $1,000 credit, actually. And then they have earnings. As you probably know, over an earnings release is typically when you get the biggest moves, most aggressive moves. And I think there's a good chance this stock can roll over. And without asking for, the world here, let's say it hits 25 by November expiration. And going over earnings, the September short letter expired. So now you're just long the November puts. So let's say the stock is at 25. Right, so then you have the 32.5 strike long minus the 25 price minus the $2 cost times the 30 contracts for your November puts. You have a P&L then of 16,500. But you also have potentially $1,000 credit that you get to keep on the short leg. So now you have a $17,500 P&L on a $5,000 spend. So that's pretty juicy. So over 3-to-1 reward risk without asking for something major, really. And we could just leave it at that. But let's also check out an alternative play in case there's a more aggressive market pullback. And, when you look at a stock that's a commodity stock, you have to also consider what's going on with the commodity because there's a strong correlation going on here. And if you look at crude oil futures, they've been kind of in a trading range for the past couple of years. Another thing you can do when you're looking at the commodity futures market, we incorporate something called Commitment of Traders Report, COT for short. It's a report that comes out on a weekly basis, and it summarizes the trading positions of different market participants in the US futures market. And for our purpose, what we care about really is what's going on with the non-commercial traders. Okay, the non-commercial traders is a category of large speculators, hedge funds, and CTAs primarily. And by the way, CTAs is basically the hedge funds of the futures world. And although they are net long, their positioning is weakening and falling into the lower end of the range right now. So they are basically in kind of sell mode. And it's not that they're always right, okay? But it's something to consider that can add more tailwind to the idea. And anyway, if crude falls off, okay, the whole energy space will suffer. And we could just buy puts on an ETF for a simple macro play. This doesn't have to be complicated. For example, XLE. XLE is the energy sector ETF. Very simple trade setup here that will capitalize on a sharp sell-off in September, October. So it's trading around 84 at this point, and just buying 20 of the October 80 strike puts for 150 will cost $3,000, keeping the risk at the lower end of the spectrum with massive upside just straight out of the gates. Because, you just never know, right? Now, as with all these setups, there are obviously many scenarios on how this can play out. But let's say we get a 15% haircut in the XLE by October expiry. Then you're looking at a $17,000 profit over a 5-to-1 reward risk. It's a very simple trade, massive upside, limited risk that capitalizes on typical September market pullback, along with what's going on in the energy space. So there we have it. That's all I got for now. Catch you later.